Welcome to MarketTimer.com. As always, nothing in this video constitutes a recommendation to buy or sell any security. Please do contact your financial advisor for any advice pertaining to your own individual circumstances. All right, looking at the markets today, another down day. No big surprise here that we were looking over the past few days at the support level was broken here to the downside. Markets continued down past that support level, obviously, today, and we'd expect they continue towards their next support level. Now, if we take a look at a longer term chart, where might that support level be? Well, there is very, very strong support, convergence of a couple of support lines just about 1,000 points or so below the market. So you can see that the old resistance line all the way back from 2009 became new support late in 2017. We also have a very, very strong bullish trend from early 2016 all the way through 2017 and into 2018. And that monthly chart that we're looking at here suggests that there is still very much a bullish trend in place. In fact, it would not be broken unless both of those converging support lines were broken, and at that point there is risk to the downside. But for now, even though there is the edges with the bears, the limit really on the downside is somewhat muted based on almost certainly those two converging support lines. Now, the big news today is that we've got information regarding Trump's tariffs, particularly that is with respect to about a 25% tariff on imports of steel and so forth. Question then is, how do you make money from Trump's tariffs? Well, think about a company that is importing and dependent on steel. Companies like Boeing and some others we'll take a look at here. If they were importing, let's just say $100,000 worth of steel, now they're going to have to spend another $25,000 to import it. In reality, imports are a smaller fraction of the overall steel usage in the U.S. economy, about a third or so. So there's a lot of domestic use as well. So the marginal hike in terms of costs is probably somewhat limited, but it's not insignificant, and that is reflected in the prices of stocks that are dependent on steel. So one of those is Boeing here. We see Boeing down 3.46% on the day. Who else uses steel? Well, Ford Motor Cars obviously uses steel. We see them down about 3% on the day. All of these stocks down more than the major market average on the day, reflecting the fact that they will be penalized almost certainly by these tariffs when they are finalized. Another company that gets punished by these tariffs, which is also dependent, is Caterpillar. We see them down about 2.85% on the day. So how do you make money off this? Well, think about what is going to happen now in investment management firms around the world. First thing they're going to realize is this is certainly a big shift, and it's probably not going to be a short-term impact. In fact, it's probably going to have a sustained and lasting impact. What that means is that the trend of these stocks is probably not, we can never say for sure, but probably not going to result in a massive spike back to the bullish side. That being the case, we can take a look at positions like Boeing, and indeed Caterpillar might be another good option. And we can look to resistance levels. And with a good degree of confidence, we can look at where there might be opportunities to enter bearish credit spread. So if you were typically looking at a bearish credit spread, you look at a resistance level and then go slightly above that. In this case, around the 165 mark is not a bad candidate. Out in time, you probably, ideally with these credit spreads, you go generally about less than 30 days if possible, just to take maximum advantage of time decay. If that's not possible because the premiums aren't too attractive, the fact that this is likely a sustained and lasting and fundamental shift in policy and government policy that will affect these companies, because all of these firms who did not take action today, did not sell these companies, they're going to have meetings in the morning, tomorrow, and over the next few weeks and say, do we really want to hold as much Caterpillar as we used to? Do we want to hold as much Boeing stock? Do we want to hold as much Ford stock? And often the first reaction is from those who are quickest to the sell button. but there is often a continuation of the trend as those meetings take place, and then further momentum builds to the downside. At the very least, we don't really care if there is a move to the downside. Maybe it's all been factored in just today, but if it has not been factored in, even better. If it is factored in, what we really care about is that there's no real move to the upside, and it's hard to see, with the exception of earnings, it's hard to see strong catalysts to the upside, and that is without earnings surprises coming out of Caterpillar, Ford, or Boeing. So with that said, if you're considering ways to generate cash flow from Trump's tariff plan, one of the very strong candidate methods now is bear calls on stocks that are dependent on imports and will be penalized as a result. Finally, for those of you who follow some of the investing gurus and one of the most successful investment managers over the past 30 years or so, Paul Tudor Jones, he was asked about what he's holding, where his money is, and he mentioned he's got a bunch in cash, but he also mentioned that he's got a bunch in commodities, and commodities are somewhat out of fashion. For those of you who may have got caught up looking at things like gold and silver during the heyday a few years ago, they often get forgotten during times like this. But in the event that the tariffs lead to a domino effect where other countries decide that they're going to impose tariffs, and then it starts to impact global trade, or that there's just simply a lack of confidence in government and bonds, and certainly the yields are not attractive, or if you get a hike in interest rates and it starts to propagate throughout the economy and we start to see negative effects. Commodities are often a way to hedge against lack of confidence in markets. Usually you don't see things like gold necessarily go up just because the quantity of money increases. Anybody who would have touted gold in the last few years would be well aware of that, even though you get the Federal Reserve issuing, essentially printing more money, buying bonds and so forth. Effectively, that does not necessarily translate into higher commodity prices like higher gold prices. So usually it's during negative times where there's a distrust in government, where people aren't really sure where to put their money. Do you put it in bonds? Well, the yields aren't great. Where stocks, well, we were looking yesterday that based on the CAPE index from Schiller, that the forward returns for 10 years aren't necessarily that attractive based on a 147-year history. You can take a look at yesterday's video to see more on that. And as a result, where do you go? Well, often you go to commodities. And so this is one example of an ETF that has exposure to commodities, and what makes it attractive at this point is just how low it's come over the past few years, where everything else since 2014 that you might look at has gone this way. We can see that commodities have gone this way, and of course, how's the big money made in the world? Well, it's often buying things that are out of favor, but in the foreseeable future, maybe not today or tomorrow or even a month from now, but in the foreseeable 2, 3, 4, 5 years, have upside potential with lower downside risk. With that said, we wish you a wonderful evening, and Ron will be returning to host these videos next week, so we look forward to his return and welcome him back. Take good care, folks.